Have you ever wondered where you should be selling your Cardano ADA in the 2025 bullish market? Well, if so, you're in luck because today I'm going to be sharing my thoughts and opinions on how I would be looking to exit my position on Cardano next year. As I get into this video, if you do find it useful and informative, smash a like button. If you're new, subscribe, and let's get into it. Okay, guys, so here we have Cardano paired up with USDT. We're on the one-day Binance chart here, and we are going to be looking at the kind of way to kind of tackle this, right? There's lots of things that we could kind of consider to kind of exit, right? We might be looking at short-term, medium-term, long-term time horizons, and we might be looking at more just kind of long-term, right? Maybe we're just looking at specifically maybe just 2025, right? Now, in this video, I'm going to be going through my thoughts and processes as to kind of how I would be looking at next year, or at least at the point of recording this video next year, but 2025, right? 2025 is looking like it's going to have a kind of bull market peak to it, and that is going to give us opportunities to kind of come out of the market. Now, we are going to use a couple of tools here to kind of help us. We're going to use Fibonacci retracement tools. I've gone through this a number of times already. This is a fantastic tool that lets you look at where the market and the participants, the buyers and the sellers, the traders, right, where they are likely to want to kind of sell and where they're likely to want to buy. This is incredibly helpful for trying to kind of predict where you want to kind of find liquidity and where you want to extract liquidity out of the market, which essentially is what this video is about. We're trying to sell our positions of ADA. Where are we going to do it, right? This tool is going to be critical for that. Now, this is not a standard one, of course. I do have my own settings. You can pause the video here if you want to take a look at it. Scroll down to the bottom here. You've got this tick box, which is fib levels based on log scale. Very important that that is ticked because my chart is in logarithmic, which you can see down here with this little L. Okay, perfect. So that's the first tool. The second tool that we're going to use is Elliott Wave. Quite a complicated tool, or it's not really a tool, it's actually a price analysis methodology. It's quite complicated, but it's worth it because it basically is insanely predictive. We have a really good success rate with it when you apply it correctly. Can be very complicated, as I say, but that is why I put together a course over at 𝗕𝗘𝗪𝗀𝗀𝗏𝑐om. It's usually linked in the description down below if you're interested. Understanding Elliott Wave can change your entire trading strategies and game and changes your mindset on looking at the market. Very important stuff goes on there from a psychology point of view. There's usually a discount code. If it's not linked in the description, guys, join us in our free Discord server and just ping me and I'll send you a discount code for it, because I do think everyone should learn a bit of Elliott Wave. It helps you understand the markets better. Anyway, let's get into this then. So what have we got going on here? Well, obviously this is the daily chart. We can see the previous bullish market, which was very, very lucrative, right? We were seeing a fantastic 17,000% move to the upside here, 17,469%. It was a very, very good strong move. Now with that, that is a 5-wave trend-based pattern. You have wave 1, wave 2, wave 3, wave 4, and wave 5. The 5th wave truncated, and when we say that, it fell short of its expected range. Let me show you what its expected range should have been. The low is this one right here, and the high is that one there. It should have been $3.05. Let me just go ahead and zoom in on that. Did it actually hit it, or... Oh, it did hit it, just about. So it just met that minimum expectation. There we go. Well, it hit the actual typical range, I should say, 1.236. So perfect. So we hit a 5-wave move to the upside. I thought it truncated, but it didn't on this chart, so that's good to see. Perfect. Okay, so then you end up with the bear market, which if you were with us back in 2022, you know I was predicting 22 cents, and well, we hit that down here. It took a lot longer than I thought to play out. To put that into kind of context for you guys, I was predicting 22 cents during this kind of move over here, and by the time we kind of got to here, which was around July 2022, I was still predicting us to go down lower, and then we got this one right in here. This was basically the end of 2022, and I thought that was close enough. We'd call it that the bottom was in for Cardano. I was clearly wrong because my 22-cent prediction from up there did actually eventually happen with that final move to the downside. Okay, and that prediction was based on Elliott Wave. It wasn't based on me just plucking a number out of the air. Elliott Wave told us 22 cent, and we eventually did get to 22 cent. Nonetheless, with that being said, that's been a great reversal spot for us because, as we can see here, we've got a fantastic reversal pattern in play with that 5-wave pattern right there. Now, I know I haven't mentioned how we're going to exit our positions yet, right? But this is a precursor to that, because understanding this structure helps us understand where the probability, or the probability of where the price is going to be going next. If we measure the high up here, which is our fifth wave high point coming in at $3.10.1, and our low point of 2020 down here, with our Fibonacci retracement tool, right, measuring the whole entire distance. So what this means is you have 0 down at the bottom and you have 1 at the top. Okay, what that means is you've measured 100% of that move. Okay, so you have 0% at the bottom, 100% at the top. That entire 5-wave structure is measured as 100%. Okay, now what I will do is, unlike what you will find that not a lot of people are going to do this, right? This seems crazy to some people, but this is how Elliott wave will work. Okay, I'm going to pick this up and I'm going to move it over here. Right, a lot of people don't understand why I do this, but there's a part of Elliott wave. Anyway, I'm going to put it over here. I did not adjust any of those levels. I just picked it up and moved it, right? So it still measures the entire distance of that 5-wave movement. I've just moved and changed its location over here. Okay, and the importance of that is I can now measure the new movement against the previous movement using the Fibonacci levels. And this is where the beauty of Elliott wave really kicks in, because it gives us some very good clean targets for that growth. Let me go ahead and zoom right in here, and I'm going to expand this up. What I've got to do is I've got to put this onto 22 cent exactly, so that we can essentially make sure that we get the numbers correct. If we don't, then we're going to end up potentially with the incorrect Fibonacci levels, and we don't want that. As you can see over here, it says 21.98, and I'm just using the arrows on my keyboard to push this Fibonacci level up a little bit higher. You can see it's now 21.99, and it's now 22 cents. That's the exact low. Now I can go ahead and zoom back out of this, and we now have Fibonacci levels based on our first movement. Okay, so what we've got here is we've measured that entire distance. It's 100%. So basically it starts at 0 here and has 100% up here. Okay, that's really important, because now that tells us that if we are to see a zigzag pattern, which is an A, B, C structure, and an ABC structure, guys, let me just go ahead and draw this in, would be a 5-wave movement followed by a 3-wave correction followed by a 5-wave movement. Right, like this. This is known as a zigzag, and it's an A, B, C structure. So the internal working of an A wave consists of 5 waves, right? The B wave is a 3-wave structure, can be any kind. And then you have another 5 waves contained inside your C wave. Okay, it's very standard basic correction, and it's a correction because it's short term. Even though we're talking about multiple years, but we zoom right out, it's actually an ABC corrective pattern. So our C wave structure would project us to move out typically towards a 100% level, as in the C wave mirrors that of the A wave. Okay, so that tells us there's a potential for $38 for ADA. However, it's a big long shot, right? Just because it kind of says we can doesn't mean that we're going to guarantee that that's going to happen, right? So instead, what we want to do is we want to take a look at these key Fibonacci levels, and we want to start thinking about where we want to exit our positions on Cardano. Okay, so for that, we're going to think about, okay, well, what's the strategy, right? Normally, before you've even purchased a cryptocurrency, as a normal investor, you should have a strategy, right? I've already got a strategy. Before I bought ADA, I had a strategy. Okay, so this is kind of where my mind is at. What we want to do is, because we dollar cost average into the market, we want to dollar cost average out of the market. We want to lock in profits on the way to the upside. But where are those key levels? We could be looking at kind of support and resistance levels. We could look at something to this effect, kind of looking here and say, look, this is a previous area right now would be a great area to be thinking about locking in profits. Its previous resistances are around April of 2022, previous support levels from May 2021, right? That could be one way of looking at it. Alternatively, I like the Fibonacci levels. Okay, so here we can see that the first profit-taking area would have been 74.42 cents. Then the next one would be here at the $1.58. The next would be maybe around $2.90, $5.34, $8.25, $12.73. And then we would have a kind of new kind of approach here coming in at $20 and $38. The problem with this is that those are very ambitious targets. There's no guarantee that you're going to hit those. Potentially not even half of them are going to get hit, right? So you want to think about this through a slightly different lens. We're going to go ahead and just take our Fibonacci chart and we're just going to shunt it over to the left-hand side. I still want it on the chart. It's very important to take a look at these macro levels, but it's not something that I need to look at right here and right now. Instead, what I want to do is I want to draw in some key areas. The first thing I'm going to do is say that the 0.618 and the 0.786 are usually the major areas of support and resistance. Okay, so these are the ones that are likely to be your kind of major turning points, specifically between $5.34 and $12.73. Okay, and then we want to measure the distance of our first reversal point from our bear market low point and this peak that we had up here on 14th of March 2024. If we measure the low coming down here at 22 cents to that high point, and then we pick this up and move it over to our August 5th low, which is right down here, coming in a low of 27.56. Okay, so 27.56. I'm going to go ahead and just drop this down to 27.56 like so. This then shows us a clear path to where we need to be heading. Okay, so understanding a five-wave pattern is very important. We have potentially got a diagonal-based pattern in here. This is kind of what I've been monitoring. We have a 1, a wave 2, a wave 3 that's still potentially in play. And for this, we could be looking at multiple different angles, but we're looking for a wave 3 to come up to $2.27. Actually, it's not even that one there. Sorry, my bad. You have your wave 1, your wave 2, your wave 3 that's still in play here, looking for a correction for wave 4 and then up to try to tackle out and take out that $2.27. That $2.27 is your wave 3 on this scale, which is a wave 1, a wave 2, a wave 3, a wave 4, and a wave 5. So why is all that important? Well, all that's really important because it tells us that there's actually a high probability that we're not going to reach those higher areas, that kind of $38 to $130 range, that 1-to-1. It's just highly unlikely, not unless something fantastic happens. So instead, what we want to do is we want to take a look at some of these areas and say, okay, well, there are a couple of areas here that actually make a lot of sense. The $1.58, the $2.90, the $5.34, the $8.25, and the $12.73. These areas then become our potential areas for dollar cost averaging out of the market. So how do we go ahead and do it? Well, taking a look at that and knowing that our structure is aligned to this particular area, we would be looking at that first area saying, okay, it's probably time to lock in about 10% of the profit at this lower point at around 158, for example. As we push up to $2.90 and we approach the previous all-time high, we are probably going to be saying, okay, it's probably time to think about locking in 30% of our bag. Let's take profit out there. Then as we kind of push up towards this next area, we are probably going to also want to do a lot more. We're probably going to want to go in again as we kind of hit $5.34, another 30%, locking in a total of 70% out of the market at this point. And then we can basically say, okay, well, as we go up to 8.25, that's 20%. Take the profit, and then we just leave the other 10% for when we think the market is kind of peaking out. Okay, this allows us to lock in profit as we push up, and it means that we can kind of take those hefty, take that profit off the table and actually lock in those gains ahead of that next bearish market. Sure, prices might move up a little bit higher. Hell, they might eventually reach some pretty lofty numbers that we never thought was possible, but that's not going to disappoint us because our strategy when we dollar cost average and purchased ADA at lower than 8 cents, well, the idea was always to push up higher. Maybe you were dollar cost averaging at 22 cents and maybe you're thinking $5, I'm out, right? Just because there's always that greed element kicking in doesn't mean that you have to kind of stick to it. Having a strategy up front removes all of those emotions from the market. It allows you to kind of take the market in its stride. It allows you to kind of lock in those profits without kind of fear that you're missing out on additional gains, right? Emotions are going to be a major problem for you when you are in the kind of crypto space. It's just going to be one of those things that you're going to have to try to tackle. And having a strategy up front is going to be massively beneficial. Now, if you do go ahead and lock in gains. Let's say that you kind of lock in profit at around $5 and you see a major downturn here. Well, you've locked in some profit. There's nothing stopping you from buying back here if you believe that the price is going to $8, because that means that you can sell it again when it comes back up here. So you can double dip over and over again as well if the market is buoyant. Okay, so to me, it makes sense to lock in those profits, the dollar cost average out of the market in the same way that you would have dollar cost averaged into the market. For me, I was accumulating ADA down at these lows of 2020, and I haven't really had a need to buy more through various reasons, but to the most part, if you're buying down in these lows or down here at lower than 42 cents, having a good clean strategy and exiting out and making sure that you lock in profits is a good thing to do in my humble opinion. But of course, guys, as I've said many times before, and I'll say again, this is just my thoughts and opinions on how I would be looking at kind of trading in and out of Cardano. If you found this somewhat useful and informative in any way, smash that like button for me, guys. I really do appreciate that. If you are new to the channel, subscribe, and don't forget to check that video out right there. It's one you don't want to miss.